Good afternoon, good evening, or good morning, depending on where you are in the world. I'd like to present to you Chapter 4 of a book called How to Write a Business Plan. And before I do that, I would like to, as I bring it all the way up here, I would like to let you know this is for review, educational, and informational purposes. It's not to take the credit for the intellectual property. The full credit to the intellectual property goes to publisher, which in this case is Nolo, and then the author, if you can get to it, Mike McKeever. Okay? My purpose here is to inform you about how to write a business plan, get you to understand about it, and just use the information that's already in the public domain. But the important thing is to give credit to full credit to the intellectual property, meaning I'm not the one who wrote it, I'm just the one who's just relaying the information. And I'm giving full credit to them, just as a disclaimer. Now, before okay, before we go into the actual explanation of what we're talking about today, I would like to let you know we're talking about potential sources of money to start or expand your small business. What you need to understand is to start a business, you're going to need some sort of capital. Now, it can come from various sources. It can come from money that you earned yourself through working for someone else or investing, made money from like Bitcoin or whatever investment, your bank, interest, I mean, any variety of things. Also, of course, investing, you can get investors, like you get institutional investors. You can get what's called angel investors, which are people who invest. Uh, these are person-to-person investors, and in other words, it's a person instead of an individual who invests anywhere from a small amount to a large amount. Institutional investors usually want to invest more because when you invest more, you get more in return. That is, if it makes money. And of course, the last one we talked about last week was in regards to a loan. Now, let's talk more about that potential sources of money. Okay. Now, I'm gonna just go over what we're gonna learn from this chapter. Okay. First, I'm gonna give you an introduction about it so you'll understand what it is. Next, we're gonna talk about common money sources to start or expand a business. The next thing we're gonna talk about is additional money sources for an existing business, and then what to do if no one will finance your business. The authors suggest try again. When they say try again, it doesn't mean to try the same thing. It means to try something different or to correct what you're already doing and try getting funding again. And then also secondary sources of financing for startups or expansions means you already have a business but you want to expand the business. And then finally, we want to make an overview of the chapter, ways to make sure that you understood what we talked about. That way we finish with that. Now, I'm not going to read this word for word because just reading it word for word, I'm not trying to do a narration. Like, for example, if I was reading a book and made an audio book, what I'm actually trying to do is I'm trying to explain what's in, just making you familiar with what's in the book in terms of the subject matter, not because of this book specifically, but because of the subject matter. But getting you to understand it is most important to understand. Right. Now, I'm going to make sure the text is a little bit larger here. It's 125%, so I figured that's sufficient. Now, in this chapter, I'll help you with the writing process because it gives you an idea of what lenders and investors want to see in a finished plan. So I'm going to highlight the main ideas as usual. Now, your ability to understand your financier's motives can mean the difference between getting a loan or investment and coming up empty-handed. See, the idea is either way, whether you're an investor, you need to see some progress in terms of it making more money than what it has now. Right? There's increase in value, or paying the loan back. Okay. Now, if you already have financial backing, you can skip this chapter. But it's also useful in terms of maybe getting additional funding, right? So businesses do are called rounds. So there's round A, round B, round C. These are investor points where investors can have a special type of investment in the company. A lot of times that refers to the types of ownership, such as shares in a company. Okay, there's basically two types of shares. There's shares where you get to vote, and then other types of shares where you don't get to vote. Both of the times you have ownership or valuation in the company, or sorry, actually equity in the company. But one allows you to vote, and the other one doesn't. Now, many people and institutions are looking for sound loans and investments. From their side of the fence, it can often seem extremely difficult to find a good one. Many potential financiers have been frightened by news stories about small business finance problems, con artists selling phony tax shelters, business bankruptcies, and so on. What does this mean to you? Simply that you must both create a sound business plan and present it and yourself in a way that that appeals to lenders and investors' needs for security and profit. Okay? Now, first thing I want to mention is that when you're looking into this, we need to get the right approach first before we go into the details. It's just kind of like if you're looking for something, you need to look in the right area, right? That's the analogy. So, what it is that you need to see it from the lenders or financiers' point of view, because they're the one who's giving you the money. Understand? It's just like a regular business. You need to see things through the point of view of the person who's giving you the money. So that's simple. Okay. If you have a good business idea and you're patient and preserving, you should be able to find financing. It was Calvin Coolidge who, sometime in the 1920s, said, "The business of America is business." It's no less true today. Okay? Now, let's talk about some basic ways to raise money. Because in a business, you're going to need capital, meaning you're going to need money or equity in it, or some sort of way to purchase goods and services to run your business. Do you understand? Most namely, money. Okay, before you can sensibly plan to raise money, you need to know how it's commonly done. Okay? Now, I'm going to give you some examples. Now, last chapter we talked about loans, but we'll go into more detail about that. So, in this case, one example is loans. Now, a loan is basically someone giving you money in exchange for a promise to pay it back. Okay. Now, in an institutional perspective, that they charge interest on that, and that's how they make money. The lender could be a bank, a friend, a family member, or anyone else willing to lend money. The lender almost always charges interest, which compensates the lender for the risk that you won't pay back the loan. I don't believe I don't believe in charging somebody more than what they borrowed, but that's how banks make money. So I have to deal with what is not what I want it to be. Now, usually the lender has you sign some paper called a note and a loan agreement, spelling out the details of your loan agreement. While these basic concepts are simple, not everybody seems to clearly understand them. For example, some people put a great deal of energy into arranging to borrow money, but think little about the hard work that goes into repaying it. Okay? The important thing to understand is that the lender expects you to pay the money back. Okay. Now this stuff sounds kind of obvious or extremely simple, but for people who have no experience with it, it may just open your eyes a little bit. Now, It's only fair that you honor your promise if you possibly can. Of course, if a person dies or in the hospital, um, there are some very rare exceptions where, okay, if the person died, well, I guess they could pay from their estate or something. But yeah, if you physically can't do anything because you're because you are in the you're in the hospital and you can't do anything. There are some exceptions to the rules, but of course it's very few and far between. Um, Now your business can be successful that you can pay back the loan sooner than the original note calls for and save some interest expenses in the process. Some state laws allows repayment of the entire principal at any time with no penalty. However, laws in some states allow the lender to charge a penalty of lost interest if the borrower pays the loan back sooner than it's called for. Now, that's an interesting concept. Paid it back sooner than I asked for it, so I want you to charge money. Make sure you read the loan documents. Now this is important. Make sure you read the loan documents and ask about the prepayment penalties. If they have a prepayment penalty or not. Now, I would say if I was a business, um, I would say it's a good sign that a person paid me back soon. That's a good sign about a person. Your lender may be willing to cross. Excuse me. Something in my throat, I think. Your lender may be willing to cross a prepayment penalty clause out of the agreement if you ask. And there's a famous saying in the Bible. They say, you have not because you ask not." What's the worst they can say is no. Might as well ask, right? Okay, there you go. So might as well ask. As for the manner in which the loans are repaid, there are as many variations as there are loans. Okay, um, so there are some, as far as repayment, there could be something like that's they do an automatic debit of an account. You put some money in an escrow in advance, and then they take it out. Okay, so the debiting and the payment, there's different ways of doing it. And then, of course, some loans, of course, can require, or do require, I don't know if can, but some can require some collateral to be put out. It depends on the agreement. Now, for fully amortized loans, this is a type of loan repayment that provides for its principal and interest to be paid off in equal monthly payments for a certain number of months. So you're paying off on two things. You're paying on the principal amount, which is the amount that you. So when they say principal, they're referring to the amount borrowed. Interest is a percentage on that amount. And that can be also calculated in different ways. Now, when you've made all the payments, you won't owe anything else. The amount of the. So this is, again, principal and interest. So either it's calculated separately, calculated together, and then payments are the same amount every month on equal monthly payments. Must be the principal and the interest is the same. That's probably what they meant. Because of course you're not going to be paying different. Your loan payments wouldn't be different for every month. That wouldn't make sense. Yeah, the interest looks like the principal and the interest are the same every month. The amount of the interest rate and the number of years or months you agree to make payments can change your monthly payments a great deal. Oh, okay. So there. All right, right. So that can vary, but once it's set, that's the amount you pay. Pay close attention to these details. Now, this is very, very basic finance stuff, but this is important to know for personal finance and also for business finance, depending on who is actually borrowing. Is it the business borrowing or is it an individual borrowing? For example, if you borrow $10,000 for 5 years at a 10% interest, you'll agree to make 60 monthly payments of $212.48 for a total repayment of $12,748.80. See how you're paying more than what you borrowed. This means you'll pay $2,748.80 in interest. Let's say you borrow $10,000 for 5 years. At a 20% interest, your monthly payments will be $264.92. Okay, that's curious. So it's okay. I'm not sure how they calculate that mathematically. You would think it would be 200, not 264. But okay, however they figure that, I'm not exactly sure the math on that. Now let's say you borrow $10,000 for 5 years at 20% interest. Then you're paying monthly payments would be $264.92, and you'll end up paying $15,895, including $5,895 in interest. So that's something called amortized loan. You have something called a balloon payment. So a balloon payment loan is different than amortized. Let me explain why. This loan sometimes calls interest-only loan. It's the other name for it. Calls for repayment of relatively small amounts for a pre-established period of time. Then you pay the entire remaining amount off at once. Okay, so the remaining is all, you need to pay all the remaining all in the next month. Wow, interesting. Um, the last large payment is called the balloon payment. So let's say you pay all the interest, all the interest you paid over a certain amount of months, and the rest of it gets paid in the next month. Ouch. The last large payment is called a balloon payment. That sounds a little bit intense. Because it's so much larger than the others, most balloon payment loans require interest-only payments for a number of years until the entire principal amount becomes due and payable. Although this type of repayment schedule sounds unwieldy, it can be very useful if you can't make large payments now but expect to change that in the near future. So remember something. You're only taking loans for a business. You're not taking loans for personal. Now, I'm going to give you I know this is going to sound very conservative and even slightly old fashioned. It may sound like it, but it is good advice. Don't take out loans unless you have to, even if it's for business purposes. Number two, don't take out any personal loans unless you have to, unless it's some emergency or something. And also, only if they like to interrupt whenever I'm doing recordings, and only if you can afford to pay it. Now, there's another thing where when they consider the loan, there's something called a cosign loan, and basically what it is if your credit is not good enough, or like for example, you don't have enough collateral, you can have someone else with their, of course, with their consent, have someone else as a co-signer, which means another person who's responsible for paying the loan. Now we have something called a secured loan. So those are called insecure, which means that you don't use your own money as sorry, excuse me. Before I say that. One is they don't have collateral on the meaning you give them something, meaning just in case you don't pay the loan by X period or whatever, you don't pay the loan, they take with the collateral, they take something of value as partial payment or full payment for the loan. Now, secure that's they don't do it, but with secure loans they do. They do that. Lenders often protect themselves by taking a security, otherwise known as security interest, in something valuable that you own called collateral. If you pledge collateral, the lender will hold title to your house, your inventory, accounts receivable, or other valuable property until the loan is paid off. This means whatever you put down as collateral is held. Loans with collateral are also called secured loans. If you don't repay a secured loan, lender sells your collateral and pockets the unpaid balance of your loan, plus any cost of the sale. Not surprisingly, if you have valuable properties to secure a loan, a lender will be much more willing to advance you money because, of course, the whatever the property is worth money. But you also risk losing your house or other collateral if you can't pay back the loan. This is why I was saying be very careful about loans. Only take out loans if it's absolutely necessary, such as some emergency or something, and also only if you can afford to do it. Now, the reason why now this is a very interesting point. If you have so much money, why would you take out a loan? The reason is because you can use other people's money. Okay, you can what they call OPM, other people's money. Easier. Now you have to pay it back, but as an easy way to raise money. Okay, so you have to consider how long does it take to raise money, and what did you have to put into it, and how long period of time. Time is money, so you have to calculate. There's other cases where they have something called mergers and acquisitions. There's lots of business things where they take out loans. And there are loans that are favorable for the person taking it out. So again, I would only recommend. Now, this is just my recommendation. Only take out a loan if you can afford to do it, and if it's absolutely necessary, such as an emergency or something for a business. Don't take out personal loans unless it's an emergency. You understand? Okay, very important. If you okay, a lender will expect you to maintain some ownership stake in the asset. This will normally be 10 to 30% depending on the type of asset and the type of lender. That means that you can't expect to get a loan for the same amount as your collateral is worth. Okay, so, of course, if you own the collateral 100% outright, well, that's different. What we're talking about is that you need to have equity anywhere between 10 to 30% because that's the money they can get out of it. If you default on a loan and proceeds from the sale of the collateral are not enough to pay the loan, the lender can sue you the remaining amount. Best advice for this is be very cautious when considering this, like I just told you. Be very cautious about considering a secured loan. Okay? See, the idea is that you take out a loan because you know you can pay it back. Remember that banks charge interest on loans, and that has to be considered. You have to consider the amount of money you're borrowing plus the interest. Now, for me, I don't buy anything that I can't pay for right immediately. So that means either like on a credit card, I would pay it off at the end of the month. I'm just saying, for example, this is the types of things I would do that I recommend for people as a responsible thing to do is don't buy something if you can't pay it back by the end of the month. Okay? On a credit, for example, on a credit cards, it's the same idea in terms of loans, but it has a different context because we're talking about business loans, but loan in general. Um, don't buy something if you don't have the money for it, and or Money for it, meaning like by the end of the month, if you don't have the money for it, don't buy it. The reason is because you're going to pay more than what the purchase price is. Okay? Of course, lenders like collateral, but it's never substitute for a sound business plan. They don't want to be selling houses or cars to recoup the money. In fact, lenders often only accept real property, stocks, bonds, and vehicles as collateral items, or personal property such as jewelry, furniture, artwork, collections. Yeah, our collections usually don't qualify. All lenders really want is for you to pay back the loan plus interest. If you have to foreclose on your home, it makes them look and probably feel bad. Here's, for example, a loan secured by real estate. So this is an example here. See, the thing is, if you take out the loan because you know you can pay it back with the interest, then take it out. But don't take out a loan that you're not sure you can take out, and especially for a collateral based loan where you're gonna lose something that you can't afford to lose, like a car, a house, something. For example, here's an example. Mary needs to borrow $50,000 to open a takeout bagel shop. She owns a house worth $200,000 and has a first mortgage with a remaining balance of $100,000. So she has equity in the home of $100,000. So it's the amount owed minus what she's already paid. Uncle Albert has offered, for example, or Joe Schmo Albert has offered to lend Mary the amount she needs at a favorable interest rate, taking a second mortgage on Mary's house as collateral for the loan. Mary agrees and borrows $50,000, obligating herself to repay in 5 years with interest of 10% by making 60 payments of $1,062.50. If Mary can't make all the payments, the second in mortgage gives Albert the right to foreclose on Mary's home and sell it to recover the money that he loaned her. Uncle Albert feels secure since he is confident the house will sell out for at least $150,000, and the only other lien against the house is $100,000 first mortgage. If a foreclosure did occur, Mary would, of course, collect any difference between the selling price and the balance of the two mortgages. So you're going to be very careful with collateral because if you don't pay it back. Now, what I do is if I take out a loan, and it's very rare I ever do, even a personal loan from a friend or something, I immediately pay them back either a week from that point or a month, maximum a month. Um, yeah, and the sooner the better, even if that inconveniences me because I want to be true to my word. And being true to your word will people will not only appreciate the fact that you are true to your word, but also the fact also will you'll get credibility from people. In terms of unsecured loans, those are loans without collateral called unsecured loans. Now, the lender has nothing to take if you don't pay. However, the lender will still be entitled to sue you if you fail to repay um, in an unsecured loan. Now, depending on what the laws are about that, but they're just speaking about things in general, okay? As a general thing, not a specific legal thing for that state or that country or whatever, because this information I'm putting out there is a worldwide information. I'm not referring to any country specific laws or any state and any in the U.S. or Canada or whatever specific laws, but it's just the general idea. Okay. Now, if he wins, he can go after your bank account, property, and business. Lenders typically don't make unsecured loans for a new business, although a second business loan may sway them. Remember, the lender's maximum profit for the loan will be the interest he charges you. So, lender's maximum profit from the loan will be the interest he charges you. So, as I said before, that's how banks make money is they charge interest. Since he won't participate in the profits, naturally he is going to make he's going to be more concerned with the security. Um, so some of those examples of unsecured loans could be like a credit card, personal loan, although everything depends on the terms of the loan, so don't forget that. That 100% depends on the terms of the loan, and it depends on the laws of the state or country that you're in. That's why I was saying when I said lender will still be entitled to sue you if you fail to repay unsecured loan. That refers to generally how things work, not specifically where you live. In terms of equity investments, we're talking about loans now, unsecured and secured and unsecured. Now let's talk about equity investments. Equity investors buys a portion of your business and becomes the part owner. It's basically like buying. It's kind of like buying stock. The equity investor shares in your profits when you succeed, depending on the legal form of ownership. The person only, they say she, but the person only shares in your losses um, up to the initial investment. So let's say your business is worth $100,000. Let's say they bought 10,000 of it, right? Or let's say 20% of it, whatever. Let's say 20%. Doesn't matter. It's what the number is. What they do is whatever they bought in terms of equity in the business is what loss they will take. Such as if the business takes a loss, that's how much the loss they can take. As they are an investor and not the actual principal owner. Put another way, most equity investors' risk is limited to the money they put up, which can be lost if the business fails. So they can lose their investment if the business fails. And then also conversely, if the investor pulls out their investment also, the business can lose the investment, depending on the terms of the investment. Investors expect you to think of their money as a tool you'll be able to use that you'll be able to use for a while, and then you'll give it back. Your business plan should include a forecast of when and how that will happen. Remember, as they're investing money in to get a profit on the return. Then at some point they want to take their investment out. Uh, and hopefully get a return on it. So depending on what the calculation is, for example, suppose they earned a 20% investment on the business and the business is worth $100,000. They started with a 20% investment at $20,000. Now with depending on the terms of the investment, suppose the business is worth, let's say, 300,000 now instead of 100. Then they've tripled the value of their investment. Just like if it went down to zero, well, then there's nothing to get out of the investment. Failing to discuss a repayment strategy in your plan can cause a potential investor to wonder about your motives. So you need to discuss a repayment strategy in your plan that can cause you need to discuss a repayment strategy in your plan. Now, to understand a little bit more about your potential backers, let's look at the dilemma they face when they consider investing in a small business like yours. On one extreme are very safe investments that produce a low profit because it's a very stable investment. Risk versus reward. More risk, more expected reward, or more. It's and also ROI, return on investment. So that's what you're looking at. So the safer ones usually offer less return because it's very safe. On the other extreme lies investments that promise a very high profit, but that uh, carry a very high risk of losing some or the entire investment. So you have to calculate and be prepared for that. My suggestion is not to invest in something that you can't afford to lose. Your new business proposal will be far less safe than an insurance bank deposit. This means that to attract money, you must offer investors the possibility of fairly high returns. Now, it depends on the agreement that you have with the investor, but they will that agreement itself and also the laws of the area will determine what's possible and what you'll be responsible for, depending on the agreement. While investors will not find your proposal as risky as casino gambling, the smart ones will know that statistically putting money into a new small business isn't a whole lot safer. Why is that? Well, because there's not if you don't have data on something, then what can you base it upon? So that's more of a risk in a way. In addition to the possibility of a big gain, investors will want to minimize the risk by looking for any security enhancing feature your investment proposal offers, such as your skill at making a business succeed and your business's profitable track record. That's why you need a business plan. And before getting that, you should show a track record of X amount of years in advance, showing what you've invested in. You'll want to offer investors the possibility of good financial return, a sense of security, and if possible, a little bit more. So what's the key things? Good financial return and a sense of security. Often, this is a vision of engaging in a business designed to enhance particularly worthwhile objectives such as health, education, or environmental concerns. Or it can be simply an opportunity to help someone with enthusiasm and drive. One of the best ways to convince a potential lender or investor that his money is secure is to convince him that you are an honest, sincere person. At least as many businesses fail to get financed because potential investors don't like the person making the sales pitch as fail because they don't like the pitch itself. Plus, it is a sales pitch. So, for the best ways to convince a potential lender of investor is this money is to ensure that his money is secure and convince him that you're an honest and sincere person. Okay. Now, in fact, when they like you and your idea, some investors, banks want to make sure that you have something to lose rather than just your pride if the business fails. They will want to see that you are backing your ideas with hard-earned dollars. Be prepared to put up most of your own money to get your business open. That's what I'm saying in terms of getting capital to start the business. Get it from your own earnings first, like from a job, an investment, something like that. This lets them know you will do everything in your power to make the business work. Sometimes your dollar commitment can take the place of other guarantees. Now, here's where the rubber meets the road. When we talk about return on equity investments, what's fair? So the important thing is return on equity investments. Each investor has their personal requirements and every deal is different. The important thing is that both parties understand the risks and thinks it's a good deal. Here are some suggestions that have worked well for others in situations where potential investors weren't well acquainted with the entrepreneur. So obviously, if you're a famous company, if you're a well-known company in your community, and you're doing good business, right? You're making money that's different. Now, one of the reasons, now the other thing I was going to suggest they haven't talked about yet is you want to look at the reason why you're taking out money. Why are you doing it? Are you doing it just to start the business, or are you doing it to reinvest in the business? Now, when you take out money, the idea is you look at it as an investment yourself. You don't look at money as a primary way of getting income because you have to pay interest and it has to be paid back. But you look at it as a way to add value to a company, cause that you're doing, and also a way that you, because you're adding value to something, at least in a temporary way, you can use it to make even more money. Obviously, if your investors are in family members, close friends, or people who wish to support your business for political or personal reasons, they may be willing to accept a lower rate of return. So if they're already familiar with your business, maybe they're more willing to take a smaller rate of return. That is probably if it's more secure. Remember, higher risk, higher return. Um, Now, here's a question you should ask yourself: should you guarantee a return? Very few investment proposals offers the investor any guarantees. So, mainly because they don't know for sure whether they're going to get a return or not. Nevertheless, some equity investors want a guaranteed return in addition to the share of the profits. If you guarantee a return, you'll pay back the original investment. So, for example, I suppose they invested $100,000 plus whatever the rate of return is that you're guaranteeing. Suppose you're guaranteeing 10%, right? Well, you're going to pay back 100,000 plus 10%. And 10% of 100,000 is 10,000. So the total is $110,000. Okay. Now, doing this is great if the project makes a profit and you think it will. But this is a risk since you'll have to get the money to pay off the investor from some other source if your business fails. If you're willing to guarantee the repayment and the profits, you may be able to get an investor to accept a return of her investment plus a reasonable profit of 20 to 30% on her investment within a year or two with a year or two time frame. Guaranteed investments are rare and I suggest you avoid the temptation to offer such a guarantee. All right? If you can put this money aside, it's a guarantee. Let's say, okay, you've put aside this fund. He invested $100,000. You put $100,000 aside in some account, different account, okay? And you say, okay, uh, the guaranteed amount was, for example, whatever the percentage is. You take that the investor's amount, put that aside, and then you put aside also the guaranteed amount as well. Let's say whatever it is, 10%. You put that aside where it cannot be spent. Okay? Most entrepreneurs with the ability and assets to offer a guarantee can secure funding at a lower cost from more conventional sources. Perhaps they can pledge their assets to a straight bank loan or sell their assets to obtain money that way. But the important thing is try to avoid guaranteeing a return because it's difficult to be able to. Well, it's not guaranteed that you will get a return. So it's important not to promise one or agree to one. If you're starting a new business and do not plan to guarantee the return of investment, you'll always need to offer investors a high possible return. If you don't put up any money, investors may expect as much as 75% of the profits. Okay, so there's two structures. Two structures you can look at. One is principal amount plus guaranteed return. That's one option. That's option A. Option B is um, giving a certain ownership or equity in the business. So they invested $100,000. Suppose you can't guarantee, for example, the 10%. Let's say you give them 5%. Well, if you give them 10%, it's basically the same thing as equity. But let's say you can't give them 10% equity, but maybe you can give them 5%. Then you give them the 5% equity in the profits. Now, if you're starting a new business, do not plan to guarantee the rate of return investments. You always need to offer investors the highest possible return. That is when before agreeing to this investment. So, for example, let's say you want to pitch an idea to raise money. So you say, okay, if you invest $100,000, you'll get X% equity in the business. That's the second scheme. The first scheme is basically you pay back the amount that they invested plus whatever the guaranteed rate of return. Second one is you give them a certain, instead of paying them back, what you do is you say, okay, you get X percentage. Well, it's actually subdivided two ways. One is you can give a certain percentage of the profits. And the idea with that is that it's going to be more than what you invested. Remember, they said if there's not secured, that means if the business goes under, they lose their investment. Okay? If there's no guaranteed rate of return. So both ways to get an equity stake in the company accept that. In this case, you could say, okay, I'll give you more. So instead of, for example, 2.5%, you give them 5% of the profits. That's the idea. All right. Another alternative for a startup business where investors bear the entire risk of the loss is for the founder to work in the business on a daily basis, receive a very small wage as a project expense. That's also difficult too because people have expenses and they need to pay their own personal expenses as well. So that may not be viable. The first profits are used to pay back all the money advanced. Profits are split on an agreed percentage. If the investor pulls up all the money, well, actually puts up all the money, this might be 50-50. The investor puts up less, and the share should be also less. Sometimes these profit splits terminate after a specific number of years, and sometimes they continue indefinitely. Occasionally, the profits parties agree on a formula to establish a price for which one party may buy out on another party in the future. Yes, they could, but it depends on their See, when you have these agreements, you don't do this verbally. You do this. You make a written contract that's legally binding. It needs to be legal in the area that you live in the world as well. So you're going to need to have a legal contract that's drawn up by a lawyer and not by Joe Schmo who doesn't know how to write a contract. Okay, and you need to. The other thing is you need to consult the laws of the country and the area of the country that you're in as well. If you're expanding an established business, returns on the adjusted toward normal bank loan rates. If the expansion appears conservative, investment profits will have to be considerably higher than bank rates that projected appears risky. The main thing is the increased risk for an established business is changing its normal course of business. That's what makes more risk is you have it goes in a different direction than normal. For example, established employee leasing company that plans to expand its receivables in the face of increasing demand is more conservative than the same company that plans to open a new office in another state. It's a higher risk if the same company plans to enter a completely new line of business, such as a management consulting or whatever it is. Okay, so that's called expanding your market or leveraging into a market, depending on how it's done. I would caution against that because it depends on your expertise, your contacts, and available capital to do such a thing. Just like starting up a new business. Now let's talk about legal forms of owning equity investments. equity investor chooses among three options in sharing ownership in your small business. Right? There are only these are the only options available, even if the consideration for the ownership share is something other than cash, such as labor, materials, and so forth. Here are some different uses for owning equity. Okay? Means getting a profit share of the company or a general ownership in the company. A general partner joins in owning the business. He shares in the profits and losses in proportion to the partnership share. General partnerships work best when all partnerships work full time in the business. Equity investors normally prefer not to become general partners because they don't want day-to-day involvements in their business, in your business. Also, by law, the partnership loses money. The investment general partner must pay back part of the losses. Everybody has heard stories of partnerships that went sour with dire consequences. These were usually general partnerships. If you're interested in forming a partnership or limited or general or learning more about them, there is a book called Form a Partnership. It will probably be something in the future I'll be talking about, but for now, let's lay the groundwork for how this all works in terms of writing a business plan. Now remember, all this information is in the context of writing a business plan. Keep that in mind. Also, we have something called an LLC or a limited liability corporation. Now, when LLCs are becoming more popular for small business owners, they offer the liability protection of a corporation, or cheaper and easier to create and maintain. Excuse me. Relation of you as the entrepreneur to your investors are similar in ways to the relationship in a corporate form. Limited liability partnerships, or LLPs, offer similar benefits, usually reserved for professionals like doctors, dentists. If you're considering either LLC or LLP, consult with your accountant and attorney before proceeding. As I'm not giving legal advice and I'm not giving financial advice, I'm just explaining the contents of this book in a way that you can understand and just giving you my own take on it, but not actual formal advice. One of the most popular methods for selling equity investments is to form a corporation. And with a corporation, you sell what's shares of what's called stock. Shareholders' potential losses are typically limited to the purchase price of their return. Okay? Now remember, these are investors. Just as before, you had an equity investor. Well, this is another type of equity investor. These people are just their losses are only up to the investment, not just like remember we talked about the general partner and the limited partner. Remember that? We're not talking about general partnership. The equivalent of a general partnership, we're talking about the equivalent of a limited partnership or an LLP. Corporate is a legal entity that is separate from you. You form a corporation by paying fees and filling forms at the state office. A corporation lets you keep management control of the business as long as you retain 51% of the shares of stock, and you can call the shots. So, for example, the reason why they say 51% is because even if you have much, let's say you had 26% share of the company, but let's say you had enough investors gathered together. Even let's say you had 49%. Worst case scenario. Let's say you had 49%, and the rest of the investors accumulated 51%, and they decided something different than what you think, then it goes by the majority. So you need to have 51% ownership of the company, or 51% of the shares of stock. Okay? How much people are willing to pay for the stock depends mostly on what you think of your prospects, because it depends on what they think the price of the stock is going to be in the future. Remember that if people buy a stock at X price, they're going to want to get more than X price in the future because it's an investment. Okay? It would make no sense to buy, for example, $1 a share. Let's say $100. A hundred shares of $1 share, for example, if it never goes up in value. Now it can go up or down in value. So this is not the same thing as usury where you charge interest on something. Has to do with there's a formula which I won't go into that is an actual formula that does a calculation for what the price of a share for a company should be. And then there's valuation of a company, which is also another calculation. It's actually a calculus formula, complicated. You can go look it up, go Google it, but basically, yes, there's a formula for estimating not estimating, for setting a price of the stock, and then the idea is that that your investment will grow in value, not stay the same or decrease. Now, if you have a firm exclusive contract to sell a popular new type of computer peripheral and only need money to build a showroom, potential buyers will probably find you. However, if you're trying to build a factory to mass produce a new and relatively untried type of device, you'll almost certainly have more difficulty because it's a risk to offer a new product in the market. It's a risk could be very high if it's innovative and it's better than the competition. And also if the brand name is unestablished, it's also a risk because maybe people won't be interested in buying it. So that's what it is. If you conduct business in a legal and ethical manner, the corporation should shield you from shareholders from personal liability for business losses. Okay? Because when you own shares of stock, if everything is legal, that is, then your loss is only up to whatever you've invested. Okay? However, officers and directors of corporations can be held personally liable for any corporate acts that break the law or breach their duty to the shareholders to act responsibly. If you're interested in forming a corporation, there's some books here you can have links here, which you can definitely look at here. And I'll include that in the description. Also by the same author, by Anthony Mancuso or Nolo, that's the publisher. These books show you how to set up your own small profit corporation and also go into considerable detail on limited liability. And acting to the subchapter S tax status, or otherwise known as S Corp. Issuing shares relating to tax status, issuing shares, holding your first board of directors meeting, etc. And of course, there's a link here to the publisher. All right. Now, here's some operational things to consider when forming a corporation. This is red tape, otherwise known as excessive operations or steps to get something done, called red tape. Corporations bring several complications, but most entrepreneurs consider the cost and inconvenience of a small price to pay for the ability to raise the capital they need. Here are some considerations to follow. Excuse me. Number one, record keeping of corporations. This is pretty much with any kind of business, is you need to have good record keeping. Keeping your shareholders informed about your corporation in good standing means that you perform certain legal acts and pay various taxes and fees. It's more complicated and expensive than doing a business as a sole proprietor. The difference is in the tax liability and other things as well. Sole proprietor, if you're the sole proprietor, means you're the sole owner. That means that you are responsible for all the taxes and liabilities of the business. Also, taxes in corporations. You can take money out of your corporation in only two ways, meaning by tax salaries and dividends. You know what a salary is, right? That's a payment for services. Dividends is a percentage on the profit earned in whatever period of time, whether it's monthly, quarterly, or yearly, and or yearly, depending on how they have it structured. Both payments have to be approved by your board of directors and entered into the minutes of the company. Salaries become your personal income and are taxed at the personal rates. Dividends are payments to shareholders made only after corporate taxes have been paid. Dividends then become personal income to the shareholders and are taxed at personal rates. So the salaries are taxed at personal rates, and dividends are taxed at personal rates. So it depends on the country you're in. They may have different tax forms. So I don't want to give a particular tax form for in this case, because depending on what country, you may have different tax forms. Now, selling shares in your corporation. So remember, we have record keeping in corporations, we have taxes in corporations. Next thing we have is selling shares in your corporation. Both federal and state regulatory authorities have many rules and regulations concerning governing sales and corporate shares of limited partnership interest. Now, this is referring to the United States. And I only say that because the whole world can see this when at the time of publishing on YouTube and Rumble. The bottom line of these regulations is this: you can't take any money into your venture until you comply with the appropriate rules. These rules try to protect investors from crooks and con artists, and also try to make it relatively easy to raise money for legitimate ventures. Before selling any security or soliciting for the sale of any security, make sure you have complied with the appropriate regulations. Okay? That's the other thing I was saying is you have to check with your local laws of wherever you're from in the world. This has just been like generally talking about structuring in general, and about things in the U.S. All right. Remember, the information here is general information. It's not intended to be legal advice, not intended to be financial advice. It's more general structuring information about different types of businesses. Okay? Now, here's some caution to consider. Lenders and landlords normally require that corporate officers personally guarantee any loans or leases that the corporation enters in until it has a several-year track record and a strong financial position. So you can expect to be held personally responsible for any company debts, even though you form a corporation or are protected from routine business losses. So it depends on whose name is it in. Is, is what I take it from here. Okay? Now, let's talk about loans and equity investments compared, meaning compare loans and equity. To raise money for your new business, you must decide whether you prefer to borrow money or to sell part of your project to an equity investor. You're going to have to look at the particulars, looking at the mathematics behind it, looking at your operations, including all aspects of the business, especially financial and sales. And also you have to look at also the management aspects in terms of upper management for board of directors and all stakeholders involved. All right. The person with money to lend or invest will obviously have a lot to say about it, but you should know the trade-offs are normally made by preferring one to the other. Here's the first one, loan advantages. Lender has no profit participation or management say in your business. Your only obligation is to repay the loan on time. This is sort of an obvious thing, but for people who have no experience with it, it may not be obvious. Interest payments, not principal payments. Remember, interest. Remember the difference between interest and principal. Principal is the amount of money loaned to that person or business. Interest is the percentage of the money lent to that person or business. Think of interest as a percentage, principal as the main amount, or the amount loaned. Okay? Now, interest payments, not principal payments, are deductible business expense. That's a good thing. I won't go into the accounting aspect behind it. Basically, these are deductible at business expenses. That means it takes away the tax liability for the federal or the state. If we're talking about the United States now, I can't comment on other states, but in general, because we're only speaking in general, not specifically for a particular state, and definitely not any specific legal or financial advice, as I've said before, just to make it clear. But we're speaking in general terms about things. Every country has their own laws, which you need to follow specifically and strictly to what they have. But in the US, this is generally how it works. So there are some advantages. Now let's look at the disadvantage of loans. The reason why you want to list out advantages versus disadvantages and disadvantages, you want to weigh the two together. It's just like good things and bad things. When you assess something, if something is worth it, you have to assess the good against the bad. Okay? The advantages is kind of like what you call the good part of it. Disadvantage is sort of like what you call the bad part of it, or the negative part of it, as opposed to advantage is kind of what you call the positive part of it. Now, with loan disadvantages, you may have to make loan repayments when your need for cash is greatest, such as during your business startup or expansion. Also, you may have to assign a security interest in your property to obtain a loan, thereby placing personal assets at risk. Under most circumstances, you can be sued for personally for you can be sued personally for any unpaid balance of the loan, even if it's unsecured. And now this is just generally how it works. This is not about any country or any state. Okay? Remember, when we talk about this in this book, we're talking about general things as relates to the context, which is the main subject, which is writing a business plan. Now, the reason why we consider all these things is because this has to be part of the business plan before we start the business, because we're trying to figure out how, number one, is the business viable, and number two, how's the business going to be structured. So the first three chapters is the business viable from a passion standpoint, from a skill standpoint, and also from a financial standpoint. Okay, so that is the business viable. Right? Now we're talking about the particulars of some more consideration, not the particular, well, some more considerations as regards to the financial aspects in terms of its obligations, and also the structure as it relates to the financials. Now we have equity investment advantages. Okay? So we have loan advantages and disadvantages. Now we have equity investment advantages. So remember we looked at loans, we looked at equity investments, different types. Now we're going to look at the advantages and disadvantages. Now, what I would have done is I would have put all the information together. This is just from the review aspect of this. I would have put all of the particulars, some general things, and I would put all that together instead of putting them separate like I did here. But it does give you the idea, an overall idea about it. But of course, you need to look at the entirety and not just part of it. It's just like when you read a sentence, you don't read half of it, part of it. You read the whole thing to get the whole idea, without presuming you know something, without reading all of it and getting the facts. In terms of an equity investment advantages, you can be flexible about repayment requirements. Investors sometimes or partners are often offer valuable advice and assistance, depending on their skill set, depending on what they're knowledgeable about. If your business loses money or goes broke, you probably won't have to pay your investors. They say probably. It depends on the exact circumstance. Okay, and depends on again, it depends on the laws of the country and the area you're in. Everything about what we're talking about in terms if we're talking about obligations or structuring, legal structuring of formal entities, is all subject to the laws of the country, which will limit or will obligate certain things to be done. In terms of equity investment disadvantages, we're talking about advantages and disadvantages. Let's talk about the disadvantages now. So I just talked about the advantages now. For disadvantages, equity investors require a larger share of the profits. Shareholders and partners have a legal right to be informed about all significant business events and a right to ethical management. They can sue you if they feel your rights are being compromised. Um, I don't like to use the word feel, but think, because feel is kind of like, how do you feel today? Are you happy or are you sad? I know what they mean, but it's more like think. Because I could feel like I'm the king of the world doesn't mean I'm the king of the world. Just because I feel like it. That's very convenient, you know. I should feel like I'm a billionaire because that will make it reality because I feel it. I feel like I have $1 billion, so I should stash away $1 billion because I feel like I'm a billionaire, and I should put $1 billion in because I feel like, No, don't rely on feelings. Rely on facts. Okay, it's a big difference. Problem with feelings, feelings have a part in terms of what's happening, but facts need to be much more relied upon because feelings can change just like the weather can change. Facts don't change, not so easily, but a fact is still a fact. Loans are better for businesses if the cash flows allows for realistic repayment schedules. The loans can be obtained without jeopardizing personal assets. That would be the ideal situation. We're talking about this in general now. Equity investments are often the best way to refinance startup ventures because of their flexible repayment schedules. If you don't already know an accountant specializing in small business affairs, it'll be wise to find one. Your personal tax situation, your tax situation of the people who invest, and the tax status of the type of business you plan to open are all likely to influence your choice. Now, as a business owner, you're going to need to make yourself more financially literate. Okay? Yes, you know how to run a business. Yes, you know how to make money, but you need to understand more on the accounting end and more on the financial end. Not so much. Yes, you need to know how to run a business. Yes, but you need to also understand the financing end of things too. Either what you need to do in the business is you need to either hire someone who specializes in just that and is an expert, or you need to take a formal course to educate yourself. If you can hire, for example, if you can hire an accountant who's an expert who can teach you whatever you need to know, that'd be best. As they're already getting a salary, you can just assign them to a task of maybe once a week, once a day, or whatever it is, once a month, teaching you what you need to know. So you understand things because as a business owner, you have the onus and you have the responsibility for whatever happens in the company. Therefore, you should be informed about the financial ends of it. Okay? You should understand what's going on. Yes, the financial people should be doing the financial work, but you should be understanding what's going on and not just relying on their understanding. Most small businesses are started or expanded with money from one or seven readily sources. Number one, this is kind of like, in my opinion, by the way, this should be kind of put towards the beginning of this chapter, but better late than never. So, okay, here's the first source: savings of the person starting the business. That's number one. Number two, money from close friends or relatives. Okay, that's your angel investors. Number three, scaling back cash requirements and substituting creative cost cutting for financial equity. So that's basically cost cutting in general. Number four, selling or borrowing against equity in another property. That's equity loans. Number five, money from supporters or others interested in what you're doing. And that's another type of angel investor. Can be institutional, can be angel. It depends on what it is. It could be bank loans and also could be venture capital. They're putting money into it as an investment. Okay? And we talked about different ways. We talked about corporations, we talked about equity investors, different types of equity investors, etc. I recommend never financing a business with only borrowed money, even if it's possible. And this is exactly what I said earlier before. Don't finance a business by a loan. This has a reiteration. If you're starting a new business and use your money or sell equity, you can make your inevitable startup mistakes cheaply and survive how to borrow money later. When you know how to better, you know how better to use it. Remember something: the more you can reduce your expenses, the more your profit can be, and the more you can operate with financially. The author's general rule is that you should borrow less than half the money that you need. And I think that's quite prudent. I would add to that as an addendum that you should only borrow what you need. Whatever it is, that's but borrow what you need. Not and also, of course, not only what you need, but what you can afford to pay back. That is, especially if you're starting a new business, if you're expanding an existing business, either starting a new one or expanding one. Remember, this is for business purposes, it's not for personal purposes. So you're expanding an existing business or you're starting a new one. Make sure you can handle the cash payments necessary to repay the loans, even if the business isn't as good as you hope. In other words, it's usually more dangerous to borrow too much than too little. Think of it like cooking, right? If you put too much on it, it's hard to take it out of the food into the mixture once it's put in. But if you put less, you can always add. If you don't put in enough, you can always add more. That's the idea. Okay? If you have to raise nearly all the money from others, I recommend selling equity instead of borrowing. I think I would agree on that point. The reason why is because there'd be more if you have equity in a business. That means that they have a vested interest in the business itself, so they have a reason to make the business succeed. And also, you have an easier way of getting people to give you money. So the only question is, how are they, and what scheme are they going to give you money? By a loan or by an investment? I'm not a greedy person. I would just say, go ahead, take a percentage as long as I have the controlling interest. I'm fine if you take your 10 or 20%, even maybe even 30%, depending on how many people are investors. Now, if you have two or more, you'd have to be you'd have to be 49% or less, but that's what it is. But yeah, I think I would agree with this point. See, the thing is, the reason why it's good is because if the business fails, then you don't, then there's not a loan to repay. Now, be that they may be some things with bankruptcy to settle in terms of assets, or whatever they can sell from the assets, but that's what it is. Now, now let's look at each of these likely funding sources for new and expanding businesses in more depth. Now, first option is we mentioned is money from your personal savings. Well, as you know, most businesses are financed at least in part with personal savings, meaning money that you put in as capital. Okay, sure, it's hard to save money, but a form of financing has also many advantages. It's worth some effort. Incidentally, savings don't necessarily come from a bank account or piggy bank. Lots of entrepreneurs sell or refinance a house or some other invaluable property to come up with cash. It's a risky way of doing it, but it's possible to do if you have the right business model and the right business plan, which we'll go into more later in these lessons. Starting with a business with your savings is the quintessential part of the capitalist idea. So you put in what they call seed money into it, and you're able to, you'll know what you're working with because that's what you put into it. As an entrepreneur with capital, you hire people, purchase equipment, and ideally create profits. Remember, we're using the money for purchasing equipment and hiring people. It's a long and honored tradition. Henry Ford, John D. Rockefeller, and other, more recently Steve Jobs of Apple Computer, started with these some money from their own pockets and end up creating industrial empires. So it's just like you're planting a seed. You're planting a seed in the soil to grow a plant, right? So the seed is basically the money you put into a business. The soil is basically the environment, and from the business and that environment, yeah, basically, yeah, sorry. That soil is basically your business. And from that business, you grow, the plant grows, right? So think of it as planting a seed. If you finance a business with your own money, you won't have to worry about making loan payments or keeping investors happy. So that's the advantage of it. Now, it means depending on how much you'll be limited to what you can use. But of course, everything is limited if you can think about it on a bigger scale because you can only borrow so much. Although what you may be able to borrow might be more than what you're able to save. Of course, the more you borrow, the more you increase your fixed operating expenses. We already talked about fixed operating expenses last chapter. For these are the monthly expenses that generally don't change. They pretty much stay the same from month to month. That's your fixed expenses. Okay. Another reason to start a business with saving is that it enhances your borrowing capacity for the future. Why? Because we have money. We actually have money, seed money that we put in that we can borrow against in terms of equity. Remember talking about equity investors? The inventory, fixtures, and equipment you purchase with your cash investments are treated as assets, which they are. Should you later apply for a business expansion? And then there's also, at least in the U.S., I don't know about other countries. I don't know the accounting system in other countries, but at least in the U.S., assets do depreciate and they are tax deductible in the U.S. So you need to talk to your accountant about how that works specifically in terms of tax benefits and tax liabilities, etc. But um, assets, at least in the U.S., do on year one of let's say let's say the first year of purchase and use, right? Those assets start depreciating. So the depreciation As far as I know now, check with an accountant to make double check this. As I know, the depreciation on an asset is tax deductible for a business. Of course, not everybody is lucky enough to be able to start and expand a business entirely from savings. There are at least two ways that you may be able to increase the amount of money you can put into your business. Let's look at the first one. You have living expense deferral. People who need just a little bit more cash than they sometimes take a risky but not unheard of step that might more appropriately be called borrowing from the future. It involves deliberately falling behind in monthly living expenses or taking cash advances from credit cards. This way of getting extra money involves risk, and it's not for everybody. So it's a matter of whether or not you can responsibly use it in a strategic way that works. So my understanding is that it's used for a very short term period of time just to get through something, and then once you're able to get through something or solve a particular short term problem, they can more than compensate for that. That's the idea. You may have a credit card too that has more credit available. By running a credit line to the maximum, sometimes you can obtain some cash from unexpected source to buy material for the business. Remember, this is for the business, it's not personal stuff. But because it's your personal credit card, as far as I know, you would have the liability to pay it back. Of course, interest rates are high and you flirt with bankruptcies. You can make payments still. Several people I know have used this method to start a business. If you have a good payment record with a telephone company, gas, electric company, and landlord, bank, and so forth, you should be able to skip several months' payments without seriously damaging your credit rating. That's the benefit of it. Of course, you'll have to catch up again fast. In the meantime, you can use the money to help get your business going. You may be able to you may be able to fall behind a month or two on your mortgage payments and generate some quick cash that way. However, the mortgage holder will take the property back from you after a few months. Don't use this method unless you're very sure you can become current again quickly. It's very risky and it requires lots of responsibility. Caution: the scheme should be tried only if you're sure you'll be able to come up with the money when you need it. As with everything else, common sense should be applied to living expense during deferral plans. Otherwise, you may find yourself trying to read a foreclosure notice in a dark room. As funny as that may sound, it's true. Let's talk about trade credit. Excuse me, I kind of have a little bit dry of a throat here. Arranging for trade credit involves borrowing from companies from whom you will buy your merchandise or raw materials. So when you start up a business, as part of the business plan, every single thing I want to tie back to the business plan. When you read something, I'm just going to give you some general interpretive tips. When you read something, you need to always relate it back to the main subject as to make it relevant and the reason why you're learning this in the first place. In other words, this is how it's going to be applied. Then the form of borrowing rarely works for service businesses because salaries are the biggest expense. Employees are usually not interested in lending you their salaries. However, I do know of a number of new businesses where friends and family members pitched in for free in the early days. It never hurts to ask. Yeah, some tech startups do that where they get a certain equity investment in the company, so they're working for free for X period of time. But then once it starts making a profit, they're going to get X percentage. So that's basically what it is. If you're in retail, wholesale, or manufacturing businesses, arranging for trade credit can help considerably in most businesses where you typically order supplies not and pay for them 30 to 60 days after receiving them. So trade credit refers to a deferral of payment for goods or services received. And then they're mentioning in terms of people working in a startup, a new business or a startup, as I mentioned, a startup, which is a new business. Sometimes people will work free for a certain period of time, so they'll get equity in the business or get traded in business, depending on what the agreement is. Right. um, in terms of what they said for retail, wholesale, or manufacturing, there is a contract agreement called letter of credit, where you ship goods, and from the time that they receive the goods, they get anywhere from 30 to 60 days time to pay for the goods received. So that's the other name for it's called LOC, or a letter of credit. So that's more for a trade business, retail, wholesale, okay, even manufacturing. But that's the formal term is called is the acronym LOC, which is letter of credit. The problem for new businesses also is that the standard practice for suppliers to demand cash upfront from startups. This possibly isn't immutable. However, often if you present your business plan to potential suppliers, you can arrange to order at least some of the supplies and merchandise on credit. So that's your LLC I told you. You can have a partial, so you can have LLC on part of the inventory or all of the inventory. After all, your supplier has an interest in helping you succeed, so that way he'll buy his merchandise for many years to come. It's repeat business, as I talked about in marketing, repeat business is where most of the money is. Also, from a strategic business management standpoint, repeat business is where it's at as well. That's where most of their money comes from. It doesn't come from mostly new customers. It comes from their existing customers because that's the people they already have, that already bought from them, and have a vested interest in buying from them. And also, another term you might want to remember is called the value delivery network. So everybody in the chain who is a supplier, technically, especially the supplier themselves. Everybody in the supply chain has a vested interest in making sure that you succeed because that ensures that they get a steady order, okay, from month to month. Steady orders from month to month, that is. And you may hear more formal terms like value delivery network. That's what that is. Meaning the value that they get is based upon, and they have a vested interest in you succeeding. So that could be from a marketing standpoint, could be from a logistics standpoint, or or anything relating to equity in a business as well, or profits in a business, especially profits in a business. The key to maintaining good relationship with suppliers while borrowing from them is to keep them informed of what you're doing and why. Okay, if you let them know what's the situation. Um, the reverse is also true too. If you're the supplier, it's important to let them know, communicate with them, ask them how they're doing. But the person receiving the goods should also communicate and tell them what the situation is. Well, now the communication rule is particularly important for new businesses. If you arrange for credit and can only pay a part of the first bill in 30 days, then pay that amount and ask the supplier for a short extension. Okay. Some suppliers may offer extended payment terms to get your business. Yes, occasionally a supplier will ship merchandise in a show a part of part of the season and let you pay for it several months later. If in the busy season before you try any of this, check with your supplier's sales reps about company policies. Your suppliers are invaluable to your business, and you want to keep them on your side because your suppliers is what gives you the materials to sell. So that's important. Also, you consider your friends, relatives, and business acquaintances. The types of financing provided by friends, relatives do not normally vary much from provided by strangers. The help may be in the form of a gift, a loan, or even equity investment. The big differences are usually with the availability of money in the first place, and the interest rate of the investment return. So your friend or relatives provide financing, however, the commercial model isn't the only one. The common alternative to loan gift hybrid here is a relative or friend lends you money at either a low interest rate or with no interest at all, telling you to pay it back when you can and treat it as a gift if you can. Obviously, this type of help is invaluable if it's available. It gives you time to get your business established with a minimum amount of pressure. If there's any doubt about the angel's financial position, remember I told you about angels investors? Angel's financial position. Make sure they consult with their banker, attorney, or financial advisor before advancing your money. Also, check with a tax advisor to see if you can receive a substantial gift in 1 year from any individual, since there may be tax implications. Generally, property you receive as a gift, bequest, or inheritance is not included in your income. However, a property you receive this way later produces incomes such as interest, dividends, or rentals. That income is taxable to you. For additional information, refer to IRS Publication 17. Okay? This is in the US, that is, remember. When they're writing this book, it's more from an American point of view because this is doing business in the US. Um, okay, so you can also find the IRS's website, irs.gov. This is for businesses located in the US. Finally, write down the terms of a loan or transaction and make sure everyone thoroughly understands them, because everybody needs to be in, you need to be you need to be informed about what it is before you agree to something. After all, you want to feel like you can go to your family reunions even if your business fails. But caution, think twice before you accept. Think about what a business reversal could do to your personal relationships, even if your relative or friend says they don't need the money. I know families that have been torn apart because a borrower didn't meet their agreements she made with the lender. Besides, a loan from a relative or close friend that comes with emotional strings probably isn't worth the cost. If you can put up money in advance, to put aside just in case, like some sort of like financial collateral, and you put it in escrow or something to be released at whatever period of time, I think that they would alleviate concerns. Um, Now, there's also something called creative cost, and I'm skipping some of this, by the way. This other stuff you can read. I already gave you, at the end of this video, I will show you the book. I showed you before, but I'll show you again the book. So for creative cost cutting, although not really a funding source, one of the most effective ways to finance a small business is to make do with less. So this is only get what you need. If your initial business proposal calls for $50,000, think about how you can reduce spending on non-essential items. Perhaps you can begin your consulting business in your home or share expensive equipment with established business rather than buying it. Those are ideas. I'm not very keen on business having a. I mean, what is the? Yeah, it's more professional to have an office, but it depends on the type of business you're in. Most of the time, most of the time, people just want a suitable place to meet. It doesn't. For most people, they don't really care too much about that. Um, of course, there'll be many situations where you need a fair amount of your money to get started. It's hard to cook without a stove, paint without a ladder, or program without a computer. So obviously, you need the equipment necessary for the business, as I mentioned before. The important point is that you should avoid raising outside money, but that you should borrow or raise equity only if you absolutely can't do without it. As I told you before, only if it's an absolute necessity. For more on the concept, I recommend Honest Business by Michael Phillips in Sully Raspberry, publisher's Random House. So this is the author's recommendation. I will, of course, be looking at that as well. Equity and other investments. You may choose to raise money from selling existing assets by pledging your equity in them as collateral for a loan, which is similar to what we were talking about before. Remember that collateral is something that you own that you give your lender title to until you pay back all the money borrowed plus interest. Obviously, if you fail to repay the loan, the lender keeps the collateral. Basically, equity is the difference between the market value. Here's what equity is now: difference between the market value and the property you own and what you owe. That is against it, plus any costs necessary to turn the asset into cash. So that's what they call liquidating, is converting an asset into money, cash. Otherwise known as cash. Cash is the actual accounting term for money. In terms of supporters, many types of businesses tend to have loyal and devoted followers. In many ways, their customers care about their business as much as the owners do. So this is your supporters. Examples are myriad of examples are as varied and varied as the likes, loves, and desires of the human community. A health food restaurant, exercise club, a motorcycle shop, a family consulting facility, a solar heating business, a religious bookstore, a kayak manufacturing shop. Good work, assuming you find your audience. So think about the audience that's involved in that as well. For supporters, who are your supporters? Think about that. In terms of banks, when asked for, in terms of banks, that is where the money is, of course. That's why you consider banks. Unfortunately, as far as small business is concerned, banks are act cautiously when lending out money. Of course, because they want to lend out to the right people. This makes sense when you remember it isn't their money. Remember when you remember that it isn't their money, it's the bank's money. The discussion that applies in financial institutions that lends to businesses and individuals. Recent banking deregulation has made it difficult to locate which various departments of institutions, such as the Bank of America or whatever bank, but some fundamentals apply. If you finally locate the right department in that person, banks always want to see a written business plan along with a loan application. Banks are financial intermediaries, okay? They process the transaction in between. So they're the one who's processing the money, okay? When lending, they charge enough interest to pay for the cost and goods to produce a profit, of course. It's another story whether that's ethical to charge interest. I don't think so, but that's what they do. And if you borrow a loan, you have to pay back the amount agreed to. Now, commercial banks also sometimes lend to a startup business, but they also almost ask for collateral to secure the loan. So remember, as we talked about before, consider that the collateral aspect for certain types of loans. The most banks will usually lend a startup is half the cash need. In addition, they'll also require that you do not borrow all or most of your cash from someone else. They want you to have as much to lose as they do. So for the total amount that you want to borrow, they're only going to give you half, which means you'll have as much to lose as them, and that's why they only want. The good news is about banks is that money generally costs less from banks than it does from professional lenders, such as mortgage and loan brokers. If the bank lending officer likes your business plan and loan application, you'll have sufficient collateral. She may give you an interest-only loan for a short time with the option of converting an amortized loan later. That means you can delay larger principal payments until your business has a chance to generate positive cash flow. So that's the idea, that's the advantage. You have some examples for you to look through. You can look through on your own. Now, let's also, before we finish, we're about to finish here, which is more to go here. We have venture capital. So, venture capital is anyone who invests equity and money in a business with the hope of future profits. This is a general term. Well, this can include any business investor from your aunt Bro, from your aunt, you know, uh, Joe Blow, or whoever, the largest investment banker in New York. The terms often they say connotes, or connotates, a group of businesses that looks for hot companies in which they can make large profits. Typically, this group won't consider any investment smaller than 500,000 and prefers companies specializing in emerging technology fields. Why? Because the more you lend out, the more money you can make in interest. That's the idea. A lot of money is where a lot of money is needed to get started, where it's possible to achieve enormous returns. Of course, that is computers, genetic engineering, medical technology, are some other examples here. Most readers of this book, as the author puts it, will be interested in starting and expanding the smaller, medium-sized retail, wholesale, or low technology manufacturing businesses. And this is just the opinion of the author. Large-scale venture capitalists traditionally do not invest in those areas. Fortunately, relatives, friends, business acquaintances, and local business people with a little money to invest can all be pint-sized venture capitalists. Basically, they're just investing in the company in terms of its equity. Now, most cities have venture capital clubs comprising groups of individual investors interested in helping businesses start and grow. Okay, so it's fairly easy to find. These clubs often serve as an introductory service. You can receive a few minutes to discuss your business at a club meeting. If any investors want to pursue your discussion further, they can make an appointment with you privately. You can use the group to expand the list you're making of investment prospects. You may also be able to obtain computerized lists of venture capitalists and investor magazines in which you can advertise your proposition. So this is basically nowadays, this would be like with the internet. You can find information on the internet to find this. Often these clubs are formed and disbanded rapidly. Ask the local chamber of commerce or your local bankers if there's any active club in your area. The thing about raising money for selling shares in your business is important to have a hard-headed picture of what you're getting into. That's precisely the reason why we need a business plan, so we can know and show what our business plan is and how this is going to work. Amateur venture capitalists or equity investors gamble on your idea for your expansion or new venture. They invest money hoping that you'll make them rich, or at least richer. If you intend to look for equity investors, your business plan needs enough. Here's what it is. If you intend to look for equity investors, business plan needs enough economic, marketing, and research to show investors that your idea has potential of making a substantial profit. Meaning, is your business plan, is this something that has potential for making lots of money, for making profits, or what is the potential of this business? You can also add additional money sources for an existing business. If you've been in business for at least 3 or 4 years and show a history of profitable operations, a whole new world of financing opens up to you. This is what you need. You need some years of positive track record to get financing. The more advantage you have over a startup is that you can prove what you say because you have records, you have history, whereas a startup can't. Be careful that if you've been in business for less than 3 years, you can't show a profitable history. Okay, you need a profitable history. Financial source may consider you a startup and put you in a higher risk category. Take at least 2 or 3 years of financial statements with you as part of your business's plan and talk to them about a financing source. That way, the lender or investor can see what you've been, where you've been and what you've been planning to do. Now, we mentioned before about trade credit. Okay, after you establish a reliable record of prompt payment with your suppliers, normally you'll consider extending additional credit for expansion plans. Okay? Let them know your plans well in advance. If you begin delaying your payments to finance your expansion without notifying them, they may get annoyed. They may have interest in seeing you grow. They have an interest in seeing you grow. After all, they're buying more of them from them in the future. That's the idea. That's how they make money, is they sell to you. Sometimes they even introduce you to these bankers and investors if you approach them with a well thought out business plan. That is the whole point of this book. A well thought out business plan. We also have commercial banks that we've been talking about before. Remember that were so hard to get money from when you started your business? Well, once you show a profitable issue, they become a lot more friendly. Why? Because you're less of a risk. An established business person can often secure flexibility from banks that might not expect. For example, they may lend you money and take a security interest in the accounts receivable. Okay? In terms of equipment leasing companies often, leasing companies own equipment that they rent to businesses and individuals. Some leasing companies are similar to rental companies that have a supply of equipment on hand that they rent out. Sometimes these companies often repair and trade in privileges in addition to short-term rentals. Other leasing companies called full leasing companies do not take physical possession of any equipment. You find that the equipment you want, and they buy it for you. Full finance leasing companies have no equipment inventory and offer you no return or repair services. Okay? They just do the financing. Okay? That's all that they do. They borrow money from a bank, so you'll have to pay back the equipment cost plus interest and leasing company service fee over a fixed time. Normally, you have the option of buying the equipment for an additional price at the end of the lease term. Okay, so this is just like cars. You can lease a car with the idea that you could buy it, lease to buy. Right? Full finance leasing companies base their credit decisions on your company's financial condition, which makes complete sense. What else are they going to base it on? They'll want to see lots of financial records from your company and may request that you pledge some of your personal assets to guarantee these leases. Remember, we talked about collateral. Of course, you can make sure you understand what you agree to before you sign anything. Make sure you understand what you agree to before you sign anything. That's what's called informed consent. Accounts receivable factoring companies. Factoring companies, also called factors, buy your accounts receivable at a discount. When they collect your accounts at full face value, they can be very expensive and release cash. I only recommend it as a last resort. Some factors require that your accounts pay them directly instead of paying you. This can cause problems with customers who assume that you have serious cash flow problems. Approach factors with caution and make sure that you understand the implications of the agreement before you sign it. Factors can buy your receivables with or without your recourse. That is, your guarantee of payment to the factor. Factoring with recourse means that your factor pays you a higher percentage of the receivable in cash and makes raising cash less expensive. But you can be seriously damaged if a big account fails to pay its bill and you have to make good on the guarantee. Remember the venture capitalists that some venture capitalists specialize in finding businesses after they have a track record and are willing to make smaller returns as a result. The industry is changing and more venture capitalists are looking into a wider range of possibilities of their client companies. Often venture capitalists will specialize in a market area and company's size stage of growth. The possibilities have increased, so has the work involved in finding just the right backers. We have money brokers and finders, which is basically a broker, you know what those are. Money brokers and finders develop and maintain a list of investors and lenders interested in business. Basically, they're the middleman for the to create the deal for the lender and the lender or investor. For the fee, they will circulate your financing proposal to potential money sources. To a legitimate broker, sorry, excuse me, a legitimate broker or finder can look at your business plan and see if you have a chance of finding money for you. Finders simply introduce you to the possible backers. They cannot negotiate on your behalf, and they are not licensed. Many money brokers are licensed and can negotiate on your behalf. So that's the difference. One is licensed, one is not. Fees for both finders and brokers. So finders are not, they don't need to be licensed, brokers do. Yeah, so fees for finders and brokers are comparable. I recommend that you work with people who are on a contingency fee basis and only do work and do not work on upfront fees. And the reason is obvious because you want them to pay based upon them producing. While some worthwhile finders and brokers require an upfront fee, there are some non-legitimate people who take up excuse me, they took upfront fees and disappeared. Also, I recommend that you obtain references from your broker or finder that the verify references. Total fees, including both upfront and contingency fees, can range from 10 to 15% of the money raised. So be cautious and remember that everything is negotiable. You can contact finders and brokers on the financial section, newspapers, classified advertising section. If no one will finance your, now this is the last point. If no one will finance your business, try again. Let's say you've been unsuccessful in your attempts to raise money for your business and primary sources listed. Okay, now what do you do? Sorry, I'm trying to just highlight that here. Listed above, or you have raised some money but you still need more. What do you do next? The final step is to go back to the people who initially seemed interested but ultimately turned you down and find out why. Okay, maybe you can fix the problem why. This is not a waste of time. If you get the same answer from several people, you will know what you have to work on. And then there's a possibility that someone's circumstances have changed and they have more funds now. Remember that it took the man who invented paper copying 21 years to raise the money to get the first photocopier made. So this is the same thing with lending for institutional investors. Pretty much anything, it's the same idea. You have secondary sources of funding for startup and expansions. So after you've done all of your tried all of your primary sources of financing small businesses at least twice, you have been turned down each time. It's time to head for the showers. No, meaning to give up. Not if you really wanted to start your business. If everyone turns you down, you have no choice but to get creative. Here's a famous saying: "Winners never quit, and quitters will never win." Now, there's one other option: is we have other governmental or institutional organizational options, such as a small business administration. They also have options for borrowing from them as well. They have a limit to how much they borrow, their loan, and their criteria just as any lending institution does. Their purpose is for small businesses, so you can see if you qualify for that. There's also something called small business investment companies. Small Business Investment Company, or SBIC, is a corporation established with the assistance of SBA to lend money to small businesses. Just similar to this as the SBA. They serve minority enterprises, minority small business and investment companies, MSSB, MSBICs, can borrow up to 4 times its invested capital from the SBA. Okay, then lends out these funds to other businesses aiming to make a profit in each loan transaction. There are some 400 of these across the country, each of these direct investment goals and objectives. So, do your research on that one. We have the rural development. This loan is aimed at businesses who provide jobs in rural America. These are different organizations with different purposes that lend to different people. There's a website here. You can look at this in further detail. And then finally, we have the Economic Development Administration, or the EDA. The EDA, which is part of the Department of Commerce, makes guaranteed loans to businesses in redevelopment areas, such as city areas with unemployment. Eligible areas are listed in publicans. Are listed in publications available quarterly at the regional FDA, EDA director. Contact your local SBA office to locate your regional EDA director. If you're one of the designated development areas, we also have the federal, state, and local programs. And for that, they're publishing a catalog of federal domestic assistance from the U.S. government, printing volume Washington, D.C. 20402. Or at your library, there's a website here. You can find it. We also have the Overseas Private Investment Corporation, or OPIC, a self-funded U.S. government agency that makes direct loans and loan guarantees and insures private businesses against political risk in developing countries. So this is more for political purposes. The ideal candidate for assistance is an American company that enters in a partnership with a well-established foreign businesses. We have a contact information and website here to learn some more information about that. We also have insurance companies and pension funds. You can borrow money from insurance companies on pension funds. Normally, whether it's visible, it's a possibility of borrowing money from insurance companies or pension funds. It's neither a visible lending source for small businesses, but some insurance companies have a small fund they invest in businesses, especially if they can offer a combination of loans and investments. However, small businesses will find money from restricted sources long before they have an application to insurance companies. And then finally, you can advertise your project and selling stock in the general public. Advertising and selling corporate stock to the general public, though, is a public offering and very different from selling stock to your friends, relatives, business acquaintances. Unless your corporation qualifies for an exemption, you must register every issuances of corporate stock with the Federal Securities and Exchange Commission, that's SEC. Okay, that's where you register your stock issuances. The state securities agency. Registration takes time and costs money. Following any of these procedures requires a knowledgeable attorney. Don't try it without help. It can be an expensive, time-consuming process. Can easily cost $200,000 in attorney fees, accountant fees, and printing expenses just to meet the government filing costs. Remember, this is for corporations, so that's what it is. Fortunately, however, smaller corporations usually qualify for state and federal subsidies, federal securities law exemptions. Sorry, not subsidies, law exemptions. For example, SEC rules permit the private sale of securities without registration if the shareholders reside in one state. This is, by the way, this is the United States, not another country. All the sales made in the state is called, that is all the sales are made in the state. It's called intrastate offering. The exemption. This is the intrastate offering exemption. Another federal exemption is called private offering. This is shares without registration. A private offering can be a sale without advertising to a limited number of people. that is 35 or fewer is often used as a yardstick, as a measurement, even though federal statute may not does not mention a number. So that's an interpretation of what as uh, limited number of people, whatever a limited number of people constitutes. Another way to qualify for a private offering as exemption is only to sell without advertising to persons who because their net worth or income earning capacity can reasonably be expected to take care of themselves. That is, they can adequately access the risk and bear the cost of investing in the business without needing protections afforded by the registration procedures of the securities laws. Most states have enacted their own versions of popular federal exemptions. And here we can see the sec.gov for more details about that. And we conclude this chapter by talking about an overall conclusion of what we should understand from this chapter. Remember that the primary and some of the secondary sources of finding money to for starting a business is if you really believe in your company, complete the business plan outlined in the rest of the book. Contact all the sources listed above if you have a good plan and take a no for an answer. You'll find the money you need. And of course, the author says that there is a Chinese saying that says, the longest journey begins with a single step. So let's get started. Okay? It's basically one foot in front of the other. And you get there, one foot in front of the other. Alright, so that will conclude this chapter. I know that was a little bit longer, but there was a lot to explain. I would have structured this chapter a little bit differently by putting everything up one section all together instead of putting it separately, but that's what it is. The information itself, of course, is good. That's why I use this as what I'm going over, chapter by chapter systematically. I'm going to be aiming to do one of these chapters 5 days a week until we finish this book itself. I will have a new book that I will have that will give out some valuable information, looking at just business knowledge in general. So, I'd like to thank you for watching this video, as I know it added value to your life, and also if you apply the principles that I mentioned, this will help you with the financial aspects of starting a business. Remember that this is not for everyone. It depends on the type of business you're in. As I told you before, this is not legal or financial advice. This is just general information for you to know as it relates to writing a business plan. Now, so please click like or thumbs up as I'll have this uploaded to, of course, at the time of publishing of this video, I'll have this uploaded to YouTube and Rumble. If you haven't already, also, please click the subscribe button. That way you'll have access to all the content on this channel, as I do have a variety of content on this channel. Also, if you haven't already, please click the bell button. That way you'll be notified of all my future videos on this channel. Again, would like to thank you for watching this video, being patient. I know that it helped you. I'd like to thank you for watching this video. Take care. Have a great day wherever